Hey, everybody. It's your boy, Sean McLaughlin at Options Sean on the old Twitter X. Hope you guys are doing well. Today is New Year's Eve. Now, is it New Year's Eve once it gets dark, or is the whole day New Year's Eve? I had this discussion with my wife this morning, and I didn't have a satisfactory answer. I feel like it shouldn't be New Year's Eve until after dark, but I could see the argument that all day is New Year's Eve. Either way, markets open all day. So we got that going for us. I thought we'd have a half day today. I'm always the last person to know. I'm always the last person to know. Anyway, this is what are my options. This is the weekly free for all show where it's kind of like an office hour situation where I'm taking questions from you, the audience, that we can dig into whatever it is you want to dig into, as long as it's options related, preferably. If you have questions about a strategy that you need help on, or help understanding or grasping, or wanting to know how to adjust certain trades you have on, or if there's a particular chart you're looking at. I see a couple of questions in already. I have some questions about some setups from Jackson, and SM Traz is asking about leaps. We'll get into both of those things first, but let's do this real quick. I learned something this week in the All Star Options chat room. And I learned something in the All Star Options chat room often. And many of the people who are in the All Star Options chat room learn something often. But I learned something new this week. I'd never heard this term before. I didn't even know this was an option. And this is great. I learned about cabinet bids. Have you ever heard of a cabinet bid? You know, like the cabinets you have in your kitchen, the cabinet, right? I had never heard of a cabinet bid. But apparently, this is a thing that people do at the end of the year, today being the last trading day of the year. If you have, and this matters if you're trading in a taxable account, right? And most people, if you're trading in a margin account, you're probably trading in a taxable account. If you have options, long options that you have on the books that have a zero bid, right? They're basically dead. I've got a few of those, right? Trade didn't work out. There's been zero bid. There's no way you're getting out. The options are so far out of the money. There's just really no shot that they're going to go in the money, particularly if they have January expiration. You can call your broker. Not all, I don't think all brokers offer this, but many do. You can call your broker and say, hey, can you take me out of these trades for a loss? Now you might be wondering, why would I want to get out of these trades for a loss? Well, if there's zero chance that these things are going to go anywhere, or if it looks like zero chance, you could close out today, realize the loss, and take that tax loss on your tax return. Now, I am not a tax attorney. I'm not a certified public accountant. So take what I'm saying with a grain of salt, or it's probably going to be unique to everyone's situation, but it's worth exploring with either your accountant and or your broker. If you've got a bunch of long options that are just zeros, and I've got a few of them, maybe you can get your broker to take them off your hands. They'll buy them, you can sell it to them for a pittance, right? You're not going to get much. You're going to get like a fraction of a penny for them, right? That's not the point. You're not trying to earn some money back. You're trying to realize the loss so you could use that on your tax return. So, food for thought. That's something I learned this week. I had never heard of this before. I've been trading for 27 years. I had never heard of this concept. I think it's fantastic. So awesome. That was you in the chat. Okay, great. JV, great. Thank you for suggesting that. That was awesome. Yes, awesome. All right, so now that I got that out of the way, I'm going to go backwards here. I had two questions come in, at least to start. Jackson and SM Traz. Let's start with SM Traz first. He's asking my thoughts on using leap calls. So a leap call, LEAP stands for, it's an acronym. It stands for Long-Term Equity Anticipation Options. I think that's what that stands for. I always get that wrong. But basically, it's longer term options that have, a year or more until expiration. And I get questions a lot from people who want to know what about leaps? How come should I be trading leaps instead of just buying the stock outright? Well, first of all, buying a leap instead of buying the stock has a few advantages. Number one, it ties up less buying power, right? If you want to buy 100 shares of stock, you're going to have to put up the margin for whatever 100 shares of stock costs. Well, if you buy a slightly out of the money call on that same stock, you might only have to put up, or the cost of that option might only be 25% of what the margin requirement would be to buy the stock. So it's a more efficient use of your buying power to use a leap. Now, leap won't trade exactly like a stock, right? You're paying premium. If you're buying a slightly out of the money call, that entire price is all premium, and that premium will decay over time if the stock doesn't go up, right? The premium decay on an option that has a year to expiration is very minimal on a day-to-day basis. It won't start becoming more noticeable until you get closer to expiration. Once you get like inside 2 months, that's when the theta decay will start to rapidly accelerate. But once you're inside 2 months, you would theoretically you would have been holding that option for at least 10 months by now. And by then you'll know whether this position is working or not. You'll either be riding a nice winner and it's great, or hopefully you would have stopped out because it was a loser and you've like recouped your capital. But leaps are great. I don't do a whole lot of them, but I did one today actually with my friend Jeff Mackey. I'm helping him out with his service, and he wanted to put a trade on in what did we do? We did Target. I'll bring up. I'm going to bring up my chart here, Gene. If you want to bring up my chart, Jeff and I were talking about Target, and we were talking about how, man, this thing has just been beat up so much for so long. It's like it's in everybody's doghouse. It's had earnings report disappointment after earnings report disappointment after earnings report disappointment, and Jeff was making the case that hey, we might have the worst behind us, but turnarounds are never easy and they're never quick and they don't usually happen on a dime. But Target might be starting to put in a bottom. So he said, why don't we go really long term? He asked me, like, hey, can we go really long term here and do something to just give us time and give us patience? And I said, yeah. We looked at the January 2027 calls in this in Target. If I bring up my options depth of market thing here, we looked at these are the January 27 options. They have 12 months expiration. We looked at the 130 strike calls. They have a 27 delta. They're out of the money. Obviously, they're $30 out of the money, but hey, we're betting on a turnaround. And the stock has been beat up so bad for so long that if this thing finally catches a bid, this thing can run back above 130 no problem in the space of 6 months or more, right? And so buying these calls for $5, that's about where you would pay if you put a limit order out in the middle. Seems like a good trade. And the nice thing about leaps is that you have so much time. They're not going to be overly sensitive to theta, right? They're not going to be overly sensitive to direction, but you get positioned and you have time on your side. So I like leaps. I don't do a whole lot of them. It's just, I'm more of a swing trader. My time frame ideally is between 3 to 9 months, ideally. But I like positioning in leaps. If I've got a thesis that we might be setting up for a big move that's going to take some time and might have a good lengthy run, and or when volatility is cheap. All right. We talk about this all the time. When volatility is cheap, that's when you want to buy options and buy further out in time because you're getting more leverage to do so. So, man, if you like a turnaround story, if there's time, leaps can be the play, especially volatility. So look at the volatility here in Target. You can see it's pretty much not at the lowest level of the year, but pretty close. That's telling me that options are cheap and options are affordable. So if you like the story, but you don't want to risk the capital of buying the stock and tying up a whole lot of capital for a long time and having the potential risk of a monster loss. I mean, look, this stock is still a dog until proven otherwise, right? There's nothing that says that, the next earnings report, this thing can't gap down to $75 or more, right? And if you're holding long stock, I don't care what your stop loss is. If we have an overnight gap and a gap's pretty big, you're going to take a bath on that stock. So that's one of the great things about options, right? You could define your risk. The most I can lose is the premium I paid for those calls. That's it. So, SM Traz, I hope that answered your question. You were asking about Nike in particular. Nike, yeah, Nike could be a good candidate for puts, or sorry, not puts, for leaps. It could be a good candidate if you believe in a turnaround. You're taking the other side of my bet. I'm short Nike right now and not liking it today. Not liking the action. I might get stopped out of this thing actually if it closes above 63 today, which it looks like it might. I'm going to get stopped out of my long puts position in Nike, or Nike, excuse me. Uh, but yeah, leaps are great. All right, let's see what's up. Let's see what other questions we have in here. JV, I'm with you, man. So great to finally be in the chat and live and live on a day off. You have a day off. Great, great. It sounds like you have another job. Good for you. It's always good to have other income coming in. Okay. What are my options with consolidation taking place in Lunar this past week? Bull flag. I'm in Lunar. I like this one. I think this thing is getting ready to take off. In fact, I put a little message out on Twitter yesterday. I said, look at this high flag here. I like this thing. I'm already positioned in my short-term account. I'm long some, I've been in it for a while. So January 14 calls, I'm making a little bit of money on them. So yes, I'm with you. I'd like it to get moving sooner rather than later. But if you're not in right now, I think you could be patient. If it gets above 17, I think is where I would consider getting long if I wasn't already long. I think that's it's a good bet. I like Lunar. I'm in it. So I'm putting my money where my mouth is. Let's see. Randy says, Happy New Year. Happy New Year to you, Randy. Are you starting? Oh, I thought that was a ticker symbol. Are you starting 2026 with 100K or starting with account balance? I am joining platform Jan 5th with 100K, risking 1% per trade. No, I'll be starting the new year with the capital that I have now. I don't plan on taking any money out. But risking 1% per trade is great. I strongly urge people to risk 1%. I'm okay if you risk up to 2%, but beyond 2%, that's too much. Okay. So I love that you're considering risking 1% per trade. That'll treat you well. That'll serve you well. You'll have meaningful wins when you win, and your drawdowns won't be that severe when you have drawdowns, and you will have drawdowns. Okay. So regardless of what capital you're starting with, whether it's 100K, whether it's 50K, whether it's $1 million, whatever your money is that you're trading, try to size your positions according to the risk you're willing to accept, and that risk should be a percentage based, based on a percentage of your account. Again, please, no more than 2%. You're just asking for trouble. You're asking for trouble. 2% is fine. That's for me, that's a limit. In fact, in the all-star options model portfolio, that's what I risked this year. 2% per trade on every trade. And I'm glad I did because I was rewarded for that. All right. But 1% is totally acceptable. Totally acceptable. Now, if you have a smaller account, maybe you got 25K or less, there will be times you may have to risk more just to participate in a one lot trade. And that's up to you. That you have to be you that's the bed you've made, and you have to be willing to accept that. And again, nothing wrong with that. With smaller accounts, if you have to risk more, that's okay. I don't love it, but maybe sometimes if there's a trade that just it's too much risk for your small account, maybe you just skip it. All right. Maybe you just skip it. There'll be other trades. There'll be other opportunities. Okay, let's see. What else is there here in the chat? JV says the cabinet bid helped a bunch of few positions. Great, great, great. Big thing. What do I think about options trade on Amazon for 2026? Well, let's pull it up and take a look. Amazon looking pretty sleepy here, which is good. I mean, other than this little earnings pop that got quickly faded, if you forget about that, if you just kind of erase that from your memory, Amazon's been consolidating pretty tightly between 210 on the low end and 240 on the high end, right? Consolidating very nicely. And volatility is relatively cheap, rising a little bit, interestingly, over the last couple of weeks, but still low, still low. If you're bullish on Amazon, now would be a great time to keep it simple and buy calls, or maybe a call vertical, because this is a $231 stock. So options can be more expensive just in absolute terms. But let's take a look at the options chain here. Let's take a look. Let's give us into the summer, right? Let's give us 6 months. Let's look at June options. And by the way, there's no magic in me selecting June options. I get asked this a lot. Like, what determines which expiration you use? Well, it's more art than science. There are a couple things that go into it, of course. We talked about when volatility is cheap, I like to go further out in time because I'm getting more leverage to do that. But sometimes if I'm putting on a tactical bet where I feel like maybe I'm catching a bounce, or Um, or maybe I'm playing it specifically playing for an earnings trade, like an earnings beat or something like that. I'll go shorter term, maybe just 1 month out, 2 months out. Um, but with Amazon, I'm thinking, hey, volatility is cheap, so let's go out at least 6 months, and that gives us a good barometer here. We got 6 months for this to play out. And I mean, look here, if you subscribe to buying the 25 delta calls, which nothing wrong with that. I like 25 delta calls when I'm expressing bullish bets because I feel like that's a nice, comfortable mix between affordability and leverage when we get it right. They would cost you about these 25 delta calls, which is the 280 strike, cost you about 670. Okay. If that's a trade you want to bet or make, that's great. Pay 670 for these calls. You got till June, and let's see, let's bring that chart back up. 280, and you're basically making the bet that this thing's going to go back to new all-time highs and then some. I mean, that could happen, certainly, right? I think the way I would play it, me personally, with my money, because it's a higher price stock, I would probably do a vertical spread, maybe buy the 240s here. Um, and let's see how far out we can go. 240s and maybe sell uh, let's sell the 290s just to make it a $50 wide spread. Let's see what that would cost me. That would cost me 1370. Okay, 1370. For a bull call spread, for a $50 wide bull call spread, 1370 is a good price. Now, some rules of thumb. These aren't set in stone, but generally speaking, when you're buying a bull call spread, you don't want to pay more than about a third of the width of the strikes. So let's see, a third of 50 would be about, why can't I do my math? Let me pull up a calculator here. 50 divided by 3. So you don't want to pay more than like 1670 for this trade, right? So we're getting it for 1370. Great. That math works for me. You're capping your upside, of course, right? You're not going to make any gains beyond the 290 strike. In fact, I'll show you what this P&L graph looks like if you're not familiar with these things. This is what this P&L graph would look like for Amazon. We're buying the 240 strike, selling the 290. We make profits from the rise from, above 240 up to 290, but then we're capped. Okay. This blue line is what the P&L would be across a range of prices. This is the range of prices along the x-axis. Okay. The P&L, or the blue line, is the P&L at expiration. On expiration day, in this case, would be June 18th of 2026. Okay. The purple line is showing me approximately what my P&L would be today across a range of prices. So if I bought this right now with Amazon trading around 231, and all of a sudden Amazon had a face ripper up to 245, let's say, later this afternoon, that's 254. I'd be sitting on an open profit of about $760. That's not exact. There's other factors that come into play. Volatility can change if that happens. So, but approximately I'd be up about $750 on this one lot. Okay. But that's what a bull call spread will cap your gains. But the nice thing here is that in exchange for capping your gains, you are controlling a position in Amazon for a cheaper price, right? If I just bought those 240 calls all by themselves, it's going to cost me about almost $19. Okay. That's $1,900 per one lot. Okay. For those of you with large accounts, great. You can totally stomach that. No big deal. For smaller accounts, that's tricky, right? But by selling the 290 calls and getting about $5 for those, it just kind of lowers my participation cost, right? Lowers my risk. My max risk is defined. I can't lose more than I pay, this $13.70. I can't lose any more than that, right? And what I would do is, if I had that trade on, remember, my gains are capped, right? The most this spread could be worth is $50. I paid 240 for it. It could go up, or I'm sorry, I'm long the 240 call. It could go up to 290, but that distance between those strikes is $50, and that's the most that spread could be worth at expiration. All right. So now I'm not going to hold this spread to expiration, even if it's working, even if the trade's going great for me. I'm not going to hold it all the way to expiration so that I can sell it for $50. That's not my game plan. My game plan will be to sell it at $40. Why 40? I'm repeating myself here because I know I've said this before on this show, but I like to sell vertical spreads. This is a vertical spread, also known as a bull call spread. It goes by many names. But I like to sell spreads like this at 80% of the maximum potential value of the spread, because If this thing rips and it goes up my way and it's trading at 40 bucks, I'm now, if I'm holding the trade trying to squeeze out an extra $5 or an extra $10, I'm risking all 40 that that spread is worth just to make an extra 5 or 10 bucks. To me, I don't like that math. The stock has already done the hard work, right? Just take the money, take the profit, move on, redeploy that capital into your next best opportunity and do it over and over again. That's the goal here. All right. Let's see. Danny Dubois, I see you, buddy. Happy New Year to you. I'll see you this week. Looking forward to hanging with you. Let's see. Frey Lee, what do you think of? Oh, we just talked about Amazon. That was you, Frey Lee. Welcome. Frey Lee, member of All Star Options. Appreciate you. I think you got a shout out in my letter that went out this morning. Um, I solicited responses from all of you, from the entire All Star Options community a couple of weeks ago, asking, "Hey, what was great about 2025? What worked for you, and maybe what didn't?" I wanted to hear, and so I've been publishing. It's a four-part series. I got a lot of responses. It was slow in the beginning. Some of you guys took your time getting to me, but eventually the floodgates opened. I got a lot of responses, and so I've been putting those out. And Frey Lee, I'm pretty sure you got quoted in my piece today. If not today, certainly yesterday. And there'll be another one coming out on Friday to conclude the series. But hey, thanks for the community for really stepping up and sharing great wisdom. Because look, we all have something to share. I don't care how long you've been trading. I don't care if you're new here or if you've been doing it for almost 30 years like me. We all have fresh insights to share. We all have knowledge. We all have insights that matter. And I learn something from people every day, just like the cabinet bid. I had never heard of a cabinet bid until today or this week. So awesome. Okay, let's see. Andrew's asking regarding position sizing. This is my favorite topic. What about the lowest level you would recommend? He's asking 25 basis points. Well, it really just matters how much capital you have, right? Andrew, if you're trading with a $20 million portfolio, great, do 25 basis points. You'll still have meaningful wins, right? Generally speaking, I think a good rule of thumb is the more capital you have, the less you should risk, right? So, once you get above, I don't know, $500,000, you probably don't want to be risking more than 1%. You can, nothing wrong with that. You're just going to have some big swings, actual dollar amount swings, right? So generally, I think, the smaller your account is, the more you might want to risk, the more you might need to risk. It might just be a function that you have to, like even just doing a one lot trade, you're going to have to risk $500 when you really only want to risk 200, right? You just have to do it. So naturally, you're going to risk more on a smaller account. But as your accounts get bigger, once you start to get into the 6 digits and 7 digits, 8 digits even, you want to probably ratchet down that per trade risk. I think most responsible large portfolio managers will tell you that. My friend, yeah, good friend. I can't even think of his name. I'll come back to that. But I know a CTA, turtle trader. He's a famous turtle trader. Why can't I think of his name? Wow, I'm embarrassed. He's a friend of mine. We talk, we hang. He's great. He manages obviously multi-millions of dollars, and he only risks like 50 basis points of his capital per trade, maybe, and probably not even that much. All right. Randy says, "Thank you, Sean. I was really referring to the 2% of account purchase with a 50% stop loss, meaning 1% risk. Does that make sense?" So Randy, what you're saying is if you risk 2% of your account on any one trade, and then you put a 50% stop loss on that trade, then theoretically, most of your losses will be around 1%. Nothing wrong with that. That's great. That's great. But just remember, just because you have a stop loss to exit the trade losing 50% doesn't mean you're always going to get out at your price. So the total value you have at risk, the total money you have at risk, that's the number you really want to pay attention to. Because Murphy's Law, if you're risking a certain amount, from time to time, that certain amount is going to get torched. It's just going to happen. It inevitably happens to all of us. So, you could theoretically think that you're going to stop out at 1% risk to your portfolio, but if you have a 50% stop loss on that trade and you got 100% of your portfolio invested in that trade, you're just asking for trouble. Yeah, your stop loss, your mental stop might be at 1%, but if if there's a potential of you losing 50% of that trade, eventually it'll happen. It's just Murphy's law. So don't even risk it. The risk of ruin is too important. That's something you have to pay attention to as a trader. Risk of ruin. There of all the errors you can make in trading, and believe me, I've made all of them. I've made every error, and I'm going to keep making more. I'm going to keep inventing new stupid ways to lose money. I promise you. But if there's one error that we all need to be hyper vigilant to avoid, that is making the error of risk of ruin, of putting our account at risk of ruin. If any one trade or any one series of trades can basically torch all of our capital and knock us out of the game, there's no coming back from that. You don't ever want to be in that position. I've been in that position. It's no fun. All right. So when in doubt, trade smaller. That's the advice I always have for everybody. When in doubt, go smaller. Okay. Would you consider Amazon an AI play? If so, the future for them appears to be strong and good for their stock price. Richard, I don't give a shit what they do. Sorry to be crass. I don't care if they're an AI play. I don't care if they're a grocery store play. I don't care if they're a delivery play. I don't care if they, I don't know, shovel sand at beaches. All I care about is the price of the stock. Only price pays. My friend Brian Shannon says that. Only price pays. That's all I care about. I don't care about the story. The story doesn't matter. On my time frame, it doesn't matter, right? If I'm a long-term investor, I care about the story. I'm not a long-term investor, not with my trading, all right? So I don't care. If AI, great. All I care is what's the price doing? Does the price support my trade? Great. If the price disagrees with me, I'm out. That's it. Okay, let's see. Okay. Texas Saint says, Texas, I don't know who that SHAWN guy is. I'd like to meet him, but sounds like a jerk. He doesn't know how to spell his name. Teams, talking about teams earlier this week. Do you see any good trades for that? Teams. Let's see. Let's pull up that ticker. I don't see a ticker for teams. I'm getting a zero. I get, there's a team. Is this the one you're talking about? Atlassian Corp? Yeah, I think I remember people talking about this one in the chat room. And I'm looking at I'm looking at that chart right now, and if I'm putting any trade on, it's a bearish trade. That's a bearish chart to me. Guilty until proven otherwise. Another saying of my good friend Brian Shannon. Man, I've been quoting Brian Shannon twice today. That's too many times. Brian, if you're listening, get out of my head. No, I would, this is a no touch for me. If I'm forced to put a trade on here, it's a bearish bet. I don't like it. I don't like it. Yeah, I know it's coiling. Everyone likes to talk about coils. Great. I don't give a shit. If I'm putting a trade on, I'm going bearish on that thing. Let's see. Snap. Yeah, Snap. I don't remember it specifically, but yeah, when we have trades, sometimes we lose all our money. That's why you have to always size your risk accordingly. I write that in every research piece that I put out on All Star Options. I say, size the position according to how much you're willing to risk, right? And I'm willing to accept 100% loss on every trade that I put on. I don't want to, and it doesn't happen very often, but it does happen. And that's okay when it happens because I know what my risk is up front and I'm okay with it. Sean, I can trade via a taxable account or rollover IRA. Any differences to consider besides the obvious? There seems to be some restrictions with the IRA. I'm not the best guy to answer that for you. I know I have a SEP IRA that I trade in, and I know that I believe that I get a little bit higher margin requirements on naked options, naked short puts and naked short calls. And I think different brokerages have different rules for IRAs, but I do most of my trading in margin accounts. So I'm not the best guy to ask about that. I'm sorry. Yeah, I'm sorry. Well, look, guys, it's been 30 minutes, and I think I've tapped all the questions. I think I have. So we got another show coming up on the channel here pretty soon. So I'm gonna free up the airwaves from everybody. But hey, everybody, please have a safe New Year's Eve if you're doing New Year's Eve things. I'll be asleep before they drop the ball. That's my New Year's Eve tradition. I'm always asleep before they drop the ball. Even, I mean, I'm 2 hours behind the New York and I'll still be asleep before they drop the ball in New York. That's how I roll on New Year's Eve. That's my old guy mojo. I like to get good rest. But hey, have fun. Congrats to those of you who had a good year. And even more so, congrats to those of you who maybe did not have a good year, but you learned good lessons. All right. If there's one positive that can come out of losing, is that when you lose, there are lessons. You don't really learn anything from winning. I certainly haven't, and maybe that's speaks poorly of me. I don't know, but I feel like when I win, I didn't really learn any lesson. I just made some money. Great. But when I lose, I often learn lessons. All right. So if you had a tough year, I know some of you did, and that's okay. You know, not everybody can outperform the market, right? That's just statistically impossible. If you had a tough year, reflect on what went wrong. Reflect on where you messed up. Review. Take notes. Internalize what you did. I've been doing this for 27 years and I learn from mistakes every year. Sometimes I repeat mistakes and I hate myself for it, but I'm getting better over time. And it's because I've reviewed the mistakes that I've made and tried to learn lessons from them and take that forward into my trading. So happy New Year, everybody. I'll be back on Friday with the options jam session. I'm not sure what time we're going to do it. I have to talk with my team because it's not we usually do it on Thursdays, but Thursdays the market's closed and it's a holiday, so I'm not going to do it on Thursday. So Friday we'll be doing the live options jam session where we're going to review all the all the adjustments and exits and entries in the All-Star Options model portfolio, and it's always a great review session for All-Star Options subscribers. So, all right, guys, girls, ladies and gentlemen, boys and girls, everybody, aliens, even you aliens. Have a great New Year's Eve, and I will talk to you on Friday. And if I don't talk to you Friday, I'll see you in the new year. Take care, everybody. Be well.